If you are going for intraday transactions or say in derivative segments, say you are going for futures and options transactions, so there is a system of margin trading. So based on the value at risk and standardized portfolio analysis, they come out with the concept called initial margin. So wherein, suppose I want to put up a trade, then I have to deposit some money, that is called initial margin. And this initial margin is based on the VAR calculation, that is value at risk calculations. Now this initial margin will take care of most of the time 1 day fluctuations of the market. And then we have a mark to market, that is called M to M margin, or say mark to market. That means every day closing price, your margin account will be settled. So if you have a surplus in your margin account, you can withdraw. If there is a loss in your margin account, then if that loss is up to the maintenance level, it is okay. But if your margin account falls below the maintenance margin level, then you will get a call from the broker for putting money into your account, or say top up your account, or say recharge your account. That means every day the transaction is settled in terms of M to M. So if somebody do not put money into the broker's account, say margin account, then next day broker will not carry forward his position. He will square off his position. So here it is a better risk management. Previously this margin trading system was not there, but now because of the margin trading system, lot of investors get the benefit of trading. Here in margin trading, you also get a benefit of leverage trading. So this is which is available right now in India. Then how the closing price is computed. So on the basis of weighted average price of all trades executed during the last 15 minutes of the trading session, this closing price is computed. And at this closing price only, the M to M settlement is done. Then there is a compulsory rolling settlement in the G30. In the group of 30 had recommended 1989 that all the secondary market across the globe should adopt a rolling settlement cycle T+3 basis by 1992. But today, in fact, we have T+2 settlement, and probably, as I said, in future we may have a T+1, means you do a trade today and by tomorrow your account is settled in terms of your demat account and your bank account. So this is what the future is. How does the stock market function basically? So if you look at, these are the participants of the stock market. We have stock exchanges. So National Stock Exchange, Bombay Stock Exchange, so NSE and BSE, these are the two popular stock markets or stock exchanges. And then with the help of brokers. So brokers are basically the registered member of the stock market. You can get a trading membership, you can get a clearing membership or trading cum clearing membership. There are rules obviously to get the membership. So SEBI is actually supervising the activity. SEBI, Security Exchange Board of India, is having a very vital role in the efficient functioning of the market. Because SEBI is the most powerful regulatory body in India, especially in the capital market segment. And SEBI do the surveillance also. If they found any activity which is not in the best interest of the investor community at large, then SEBI will take steps. Today, SEBI do a lot of awareness programs, investors protection and investors rights. They are making a lot of awareness programs through SEBI certified resource persons. SEBI also design new rules and regulations. Recently, you must have heard that there was a problem with NSEL, and the Forward Market Commission, which was the regulatory body of these commodity markets, now merged into SEBI. So SEBI has now wide coverage. These regulatory bodies are actually playing a vital role in the efficient functioning of the market. Like in India, we have Insurance Regulatory Authority for the insurance business, IRDA what we call it. Then for banking system, we have a Reserve Bank of India which takes care of the entire banking system in India. Similarly, SEBI takes care of the capital markets. So SEBI come out with the rules and regulations. Like the first step, when you want to do a listing of the securities on the stock exchanges, then you have to follow the guidelines, SEBI guidelines. If you come out with the primary issue in the market, you have to follow the SEBI guidelines. So SEBI is having a very important role in the secondary market, especially regulatory role. Then another role is of brokers and sub-brokers. Now brokers and sub-brokers are basically the people who work at a ground level. That means they are directly connected with the investor community, especially retail investor community, institutional investor community. So they are also playing a very vital role in the functioning of the stock market. Suppose today me and you want to do a trade, then we have to contact the nearest broker first. Open up a demat account at broker's office. So once I open the demat account, I need PAN card. PAN card is must for opening up the demat account, which we call the KYC guidelines. Know your customer. So today, with all KYC guidelines, which is by the SEBI, that with the help of only those guidelines, you can open up the demat account. Once you have demat account with you, then you can start trading activities. And today, your demat accounts are also linked with the net banking. So your payment mechanism is also very easy. Then we have registrar's office. They are also playing a very important role. Then depositories and their participants, DPs. Now these depository participants, basically they are the people who are giving you the demat accounts. And all your physical shares are with the custodians. Custodians who keep the physical shares, and you have then demat shares available to you in your depository participants DP with your DP. Now very important, how do I measure the stock market activities? Now every day there are a lot of news about the market. Somebody say, oh, today market is up, today market is down. So how do you measure? How do you say market is up or market is down? What you look at? Actually look at index. So actually index is a number that used to represent the change in the set of values between a base time period and another time period. So like if I look at Bombay Stock Exchange, so I look at Sensex, Bsc Sensex. So Sensex is basically an index who tracks the market movements. If I look at NSE, National Stock Exchange, then the index is called Nifty. So Nifty is also an index that tracks the market. So this stock index is a number that helps to measure the levels of the market, and they attempt to be proxy for the entire market. So at times in research, when we calculate market returns, what you look at? You look at the returns that you get from the Sensex or the returns that you get from the Nifty. So they are called the market returns. So index plays a very important role, and actually these index are called barometer of the Indian economy. Suppose I want to make some conclusion about Indian economy, whether economy is doing well or not. So how do I look at? I look at Sensex. If the Sensex and Nifty are going on the upward side, it is a positive sign for the Indian economy. People look at it positive. But friends, stock market is highly volatile. Why it is volatile? Because whatever shares are listed on the stock markets, their trading activity is done based on the perception of the investors about their stocks performances. So what happens? Stock market is a mixture of rational and irrational things. It may have some influence of the greed of the people. So basically, the buying and selling activity is based on the actual performance of the company's shares or company's profit and loss account and balance sheet, what we call it fundamental analysis. Along with that, people take up their trade decisions in the stock market based on technical analysis. That means they study the past behavior of the stock prices. They study the past behavior of the stock prices and then they take up the actions. So basically, in stock market, for trading purpose, either you follow the fundamental analysis or you follow the technical analysis. Fundamentals will tell you what to buy, which are the good stocks to buy, while technicals tells you when to buy, when to sell. So both rational usage of fundamental and technical analysis will help you in this market. So this index is basically a representation of the entire market. So like we have different usages of the stock index. You can track average returns. So now how do I compare my investment performances? So suppose I have invested into say FD, fixed deposits of the banks. I invested into some other investment avenues. So I compare with the index. What average returns that Sensex is giving to me? What average returns Nifty is giving to me over a period of say 5 years or 10 years? I compare that with my other instrument. So it tracks the average returns. It is also comparing performance of the managers. I am talking about the fund managers. See, today in India, we have a very good business of mutual funds. Mutual funds are basically investing on behalf of their clients. They are investing into the equity shares. So how do you track their performances? So indices returns can become a benchmark return for them. And we have derivatives on index. Like we have futures on say Sensex or say Nifty futures. So that is a derivative product which is based on index. So we have lots of usage of the stock index, and essentially every day we observe the stock index movement to understand whether the market is doing well or market is not doing well. Then stock market indices are the barometer of the Indian economy. We have Bsc Sensex, NSE 50, and we have some commodity indices also. We have some sectorial indices also. Sector specific indices are available on the Bsc, NSE both websites. Now what is their usefulness? So the investor can use the indices to allocate the funds rationally among the stocks. Technical analysts use these indices to predict the future market. And indices function as a status report of the general economy. So as the same thing, that these are the usage of the market indices. Now if you look about the Bsc indices, the launch of the Sensex was in 1986, was later followed up in January 1989 by the introduction of the Bsc National Index, and the base year was 1983-84. So it comprised 100 stock listed at a 5 major stock exchange in India. Then later on they have introduced a dollar-linked version of Bsc 100 in 2006. Then with a view to provide a better representation of the increasing number of listed companies, BSE has introduced BSE 100, then Dolex 200. So many new indices, even public sector undertaking index is also introduced. Then technology index are also introduced. So many indices, you can see from the slides that broad market indices, sectorial indices, dollar linked indices. So these many indices are introduced by the Bombay Stock Exchange. And similarly, there are indices in National Stock Exchange, like major is Nifty, S&P CNX Nifty. Now friends, let me tell you here for your knowledge that when you say BSE Sensex, it comprises of the 30 stocks. And when you say Nifty, it comprises of 50 stocks. So best 50 scripts as per their criteria, they are tracking the performance in NSE Nifty, and 30 stocks in the Bombay Stock Exchange, they are tracking performance through Sensex. So the main job is to capture the price movement. So a stock index will reflect the price movement of shares, while a bond index captures the manner in which bond prices go up and down. So both these indices we have in India. And which are the stocks which will be the part of index? As I said, 50 stocks in case of Nifty and 30 stocks in case of Sensex. So there are criteria like what is the market capitalization of that shares, the liquidity, the continuity in the market, whether they are representing the entire industry, and what is their listing history. So these things are taken care of, and then based on the performance in these five criterias, the exchange decides to put that stocks into the index committee. So here you can do construction of index based on price weighted, market value weighted, equally weighted. The couple of indices like Dow Jones Industrial Average, a price weighted average, and which uses the arithmetic mean. Arithmetic and geometric means, or these are the averages which are used by the various indices. So it is simple. Arithmetic is sigma x upon n, what you call it. So you add up all the stocks and then you divide by 3. It is arithmetic average. In geometric, it is 1 plus r. Then you can do the nth root of that. So that way you can get a geometric average. Computation of stock index. This is one simple table. Suppose I keep a 3 stocks, Tata, Infosys, IBM.